What's up, mi gente, our gente? Thanks for joining our monthly market report for November. We heard this and we believe it's true. Most agents know what's happening. Good agents understand what's happening. Great agents can explain what's happening. And that's what we're about at CGX, explaining what's happening. I'm a former educator. Yvette's a former nurse. Understanding and teaching is part of us, and that's not an easy task in today's real estate environment. So let's jump right in with the quote from Sean Dobson, the CEO of the Amherst Group. He put it well about the housing environment. I'd say this: whatever our forecast is, it has a wide range of error than it normally would have. We're at a point in the housing market where no one really knows to tell you the truth. But we can't ignore that throughout the country, inventory remains down over 40% since the pre-pandemic.
What is he saying? Two things. Number one, no one really knows for sure what's going to happen next. We can make some good guesses, but we have to realize they're guesses. Number two is the only thing we know for sure, no denying, is that there's not enough inventory, nationally and regionally. So if there's not enough inventory out there, prices won't crash. It's a supply and demand issue with any price on any item.
Let's look at what's happening with home prices throughout the country and then locally. The Case-Shiller report came out last week. We saw the seasonally adjusted numbers were up almost a full percent. Usually, this is a time of year where the level of appreciation starts decelerating. That's not red bars, that's just those green bars would get smaller. And that didn't happen with the Case-Shiller report. And we're interested because some people are talking about a reacceleration of home prices. So if you're looking to buy, you don't want that, right? But people are talking about it, which brings me to this point, which we believe is critical, and that is real estate is local. Yvette and we're IE all day, every day, especially San Bernardino, Riverside, and Moreno Valley, right? So you already know that gentrification is hitting each of these cities. Gentrifying neighborhoods experience even more growth during hot national real estate markets, right? Those trends will be the same. So we need to talk about those national numbers. However, during bad times, and I'm talking about bad like 2007, 2008, that crash, I can point to instances where real estate values held and sometimes even went up in gentrifying areas.
That's deep. The FHFA price index came out also, and they're showing prices as we come later into the year are starting to moderate. And at the beginning of last year, we had very strong appreciation. At the end of last year, there was a correction to that too strong appreciation, and now we're going back to normal appreciation levels. So, although overall we're seeing especially strong price appreciation for this time of year, if we look at the Case Shiller on price index, 9 of the 20 cities that they cover, nine of them had 1% appreciation or more just last month. And in places like Vegas, Seattle, LA, and San Diego, that really took a hit last winter, are coming back strong. I.e., pay attention. You know what happens when prices go up in LA and San Diego. So for anyone waiting for a crash, it's not going to happen. And if anything, they're going to stay right on normal appreciation.
Yep. Looking ahead, values are strong. My fear is not that they're going to be weak. My fear is going to be that they might be a little bit too strong, especially if they reaccelerate. With affordability in crisis mode, I'm not looking for tremendous price growth. I'm looking for steady price growth, normal price growth, right? There are a lot of young people, a lot of older people. There are a lot of families that have the dream of home ownership but can't attain it right now. Look how much monthly mortgage payments have increased since January 2021, since January 2022, since January of this year. And that's just a major challenge right there. Interest rates are nowhere near where they were the last several years.
We can see from 2016 all the way to 2022, mortgage rates stayed under 5%. Then in 2022, they shot up and now they're higher than that. We did get a good reprieve last week. Mortgage rates actually dropped significantly from the highs of over 8%. They finished last Friday at 7.38%. We compared 2016 through 2022, and those are the orange bars down below, and the blue are up above. We can go all the way back to the 2000s, and rates weren't as high. Mortgage rates are impacting affordability in a major way, but not necessarily the want of homeownership. Owning a home is still a major piece of the American dream of building generational wealth. Look at this housing trends report survey from the National Association of Home Builders.
We see things going down 18 into 19, and then obviously in the first quarter of 2020, we had the pandemic. Then all of a sudden, things shot out. They settled back out after that big jump, right, because of the pandemic buying, and then they bounced around. If you look from 2020 to now, that's not going down, right? If you look from just 2023, what we're seeing, it's bouncing up and down. If people were no longer interested in buying a house, that line will be down, headed toward the bottom right corner. So the desire is there. We just need to come up with different solutions to combat affordability. And multi-generational living could be a solution.
A study done by Pew Research says multi-generational living works for a lot of people, and 58% of folks says it's convenient most of the time. And that makes sense. The couple with kids has a built-in babysitter with grandparents, and grandparents, as they become empty nesters, bring in a pet and have built-in pet sitters too. It's convenient for a lot of people. More than 50% said most of the time it's rewarding. Imagine grandparents, their adult children, and their grandchildren all living together, helping each other out. Isn't that what family is about?
The arrangement actually works for my family, or my mom, right, who lives with my sister's family, and they all love it. The built-in sitter is real. My mom gets to live with the family who loves her. She gets to see her grandkids. Personally, I couldn't be happier knowing that my mom is being taken care of like that. So I do think that is something that we should take a look at, and something that we should really grab a hold of, rather. It's not for everyone. Look at the last bar. 23% find it stressful. So obviously, if you hate your parents or your adult kids, don't move in with them. Look, the circumstances over the last couple of decades between the 2008 financial crisis and the COVID-19 pandemic have changed the way families are buying houses. According to data from NAR, multi-generational buying rose to an all-time high in 2022 to 14%. Compare that to 11% in 2021. That's a 30% increase in the number of people who are buying multi-generational homes. That's because it works, and more than 1 out of 10 houses that are sold are multi-generational homes.
Solution, especially in California, is accessory dwelling units. ADUs. In California, we implore folks to take advantage of some of our housing regulations that allow the construction of ADUs, lot splits, and ADU condos. They can help with affordability and maintain and grow community. This from Pew Research. Multi-generational living has increased among all age groups over the past 5 decades. The increase has been fastest among adults ages 25 to 34. This could be one of the answers to the affordability challenge that millennials are facing right now. Builders are already designing multi-generational floor plans that include designs with 2 master suites, including main floor suites and kitchenettes.
Another policy change folks need to know everywhere. Fannie Mae has announced that it will accept 5% down payments for owner-occupied 2, 3, and 4-unit homes. This is a departure from the previous multifamily financing requirement of 15 or 25%. So it used to be you have to get an FHFA, and now they're even doing the FHFA with the ADUs. But now even Fannie Mae is saying, if you buy a 2-family house, you buy a duplex, your parents live in one, you live on the other side, we'll let you buy that house with 5% down. And let's talk a little about net worth, because whenever we're talking about affordability, we always want to talk about what's the rent payment versus the mortgage payment. We have a calculator on our website. You should check it out. In the vast majority of the country, let's be honest, it's right now less expensive to rent than to buy, given the interest rates on the surface. When you include the mortgage interest deduction and property tax deduction, when you start doing those things, the bottom line is it's better to own than to rent. And also, that's not even considering appreciation. Even though the monthly housing expense may be less right now, and maybe for the next year or a couple of years, if you bought a house today, you're virtually locked into your monthly housing expense forever, right?
What about property taxes going up?
Well, most municipalities are not going to kill the goose that lays the golden egg. Property taxes do rise, but most likely within a percentage point, right? They don't want a bunch of foreclosures in their market or a bunch of quick sales that are going to drive down property values, right? They need those property values to be strong. So really, your housing monthly expense, if you're an owner, remains virtually unchanged for the next 30 years.
But if you stay renting, watch your rent payment 5 years from now versus today. Watch your rent payment 10 years from now versus today, 20 years from now, 30 years from now. Matter of fact, 30 years from now, you're still going to be paying rent, but your mortgage will be paid off. And that's what people don't understand. Equity and real estate have long term benefits. And here's a graph that kind of explains that. The Fed does a study every 3 years. It's called the Study of Consumer Finances. And one of the things that comes out of that study is the difference in net worth between homeowners and renters. What we see going all the way back to 2010, right in the middle of the housing crash when prices were plummeting, still then homeowners had much greater net worth than renters did. As we go through the next study and the next study and the next study, and the last study that was just released about a month ago, which covered through 2022, the spread, that gap is growing dramatically. The last tick up from 2019 to 2022 is not going to continue. That was the Russian price appreciation during the pandemic. That line's going to flatten out.
For the vast majority of families in the country, home ownership is the number one builder of their net worth. No doubt. No matter what age group you're in, you'll have more net worth if you're a homeowner versus a renter. At every income level, a person who owns a home, going all the way down to the lowest income levels to the highest income levels, people who own houses have more net worth no matter what their income is. Beyond that home appreciation, having equity allows you access to other things. Aspiring entrepreneurs, here's one example. The blue line is the U.S. small business application in thousands. How many people actually started a business? The green line is the capital equity in billions. Right? You don't have to worry about the thousands and billions. You just have to look at the two lines because there is definitely some sort of connection. Right? It could be causation, correlation. You can argue that point. But this is what I know. When people's equity goes up, and tappable equity, meaning 80% of the value of the income, right? Folks always want to keep 20% so they're not using all of their equity. The more equity you have, the more confident people are that they're going to start a business, right? As the equity built, so did businesses. As equity started to fall off a little bit through the second half of last year when prices dropped, so did some business applications.
Part of the dream is home ownership. Another part is people want to be their own boss. They want to start their own business. Many businesses in this country started by taking equity out of a house and starting the business in the garage of that house. So that's another part of our business, commercial real estate. Robert's been involved in commercial real estate for 25 years, and we help homeowners leverage their equity to purchase commercial property for their business or as an investment vehicle.
That was a lot of information, but important information. The main thing for you, if you want to be a homeowner, and I wholeheartedly recommend it, is to get with professionals who can analyze your unique situation and guide you through the process of getting into home ownership. We work with a couple of lenders, each with their unique programs that could benefit you, right? We introduce you to them. You choose the one that you feel most comfortable with.
Home ownership, especially in the Inland Empire, is attainable. Reach out. It doesn't matter what stage of the process you're in, we can and want to help. That does it for our November's report. I'm Yvette Romero.
I'm Robert Carrillo. We are Carrillo Group CANY, where we do
Real estate with purpose.
Peace.